I had an uneven original college career. Biology and chemistry were my majors. And around my third year or so, I figured, you know what, I need to go straighten my head out first. So I left for a few years and did a variety of different jobs. I knew from my mother that in principle, college is easy, working life is hard, right? But I had to learn it through my fingers and my feet.
Yeah.
And eventually, after a few years, I realized at the end of the day, I come home and I'm just tired. I want to put my feet up and eat some ice cream and watch television. And if that's what it's going to be, then I'd rather do something I like and make more money than being a veterinary technician or a kennelman or a temp typist. So it just happened at that time. I was doing some temp typing at a boutique investment firm, which meant nothing to me. I was just doing some typing for them. And to show you what the depth of my ignorance, I hardly knew what the stock market was. I couldn't tell you what a debenture was. The financial section of the newspaper is the part I threw away so I could get to the funnies faster. Okay? Anyway, they liked the work I did for them as a typist, and they asked me if I'd like to work for them permanently, which was great. So I didn't have to be a temp typist, and I could get a permanent job. And it just so happened that it was summer of 1982.
Ah, okay. Good time to join the stock market.
So I knew so little about it. I was doing data entry for them on their portfolio management system. This was pre-PC era.
Okay.
So it's a dumb terminal that has a big, thick data wire that's hardwired under the streets of Manhattan to a data center where they would process transactions and price securities at the end of the day and so forth. My job was to operate that and make corrections to performance and so forth. And I knew so little that I saw some holdings in an account, a lot of accounts, that held something called Schlumberger. I didn't know it was called Schlumberger.
Right.
And I saw that in this particular case, the cost column was several multiples of the market value column. And when the head, the principal and chief investment officer and CEO of this investment boutique walked by my desk, I was impolitic enough to ask him. He said, is this wrong? I thought maybe they were reversed and I should correct it. And to his credit, he didn't get angry at me. He said, no, we really did buy it at 100 and it really is whatever, 10. And then he explained a little to me. It actually was what got me excited about the stock market.
Really?
There are two things that got me excited about the stock market. One was, he explained to me, took 2 minutes, and he explained there was this OPEC oil embargo. And oil prices went up to $100 a barrel. People just thought it was going higher and higher. And Schlumberger and all these other stocks you see here, names that have disappeared like Varco International and so forth, that they were great, blue chip companies and growing, we bought them. And then when the embargo ended, he said, immediately, he said, I wrote down the sale tickets and I walked them right over to the order desk. And the order desk the trader handed it back to him. And they said, we don't have a bid. And he said, can you imagine that Schlumberger? You couldn't get a bid.
Yeah.
I had no idea what he was talking about, but it sounded very exciting. Right? He says, wow. Like, I was impressed by how impressed he was.
Yeah.
He was still at that time. It's amazing you couldn't get a bid on Schlumberger. I thought that was exciting. Didn't know what it meant. And then came August, when the bull market started. What people think of as the stock market started. After just the longest period of unhappiness. And I watched the three principals, men with gray hair, gathered around the Quotron machine, because people didn't have PCs, and they were looking at the prices going up and the index going up, and they sounded like little boys. They said, wow, geez, would you look at that? I've never seen volume like that. Anyway, it looked exciting. So since I was ready to go back to school at that point, but I wasn't ready to go back to the biology and chemistry, I figured, I'm here, let me get some context. I'll take some accounting and economics courses.
Right.
And thereby, purely by happenstance, a career was birthed.
It's funny, I remember someone telling me, I can't remember who it was, you probably interrupt me and say it was you, but I remember someone telling me around that time that they got promoted to an insanely senior position because the top guy came in and threw out all the heads at that exact time and said, you're not scarred. You haven't been through the bear market. You're the only guy that had the balls to buy shares. you're in. And literally put him in the seat and kicked out all the old guards. He said, they won't, he said, I think the market's turned. They won't have the guts to follow that.
That is very intriguing.
Yeah.
That's a bold thinker.
A really bold thinker. I'm racking my brains to think who it was.
But in fact, I might come back to that if I remember. My memory is a little sieve-like when we talk a little bit about indexation, because this notion of scarring fits into, in the modern era, the scarring, the trauma, all sorts of participants in the marketplace experienced during the financial crisis, both 2007, 2008, and it affected them in ways that have had deep and long repercussions and affect valuations right now in the indexation, I'll call it vortex that we live in.
Well, we will definitely come back to that, but there's a reason I want to go back, because I listened to your interview with our mutual friend Jesse Felder, which is fantastic. You know, Jesse's a great guy, a good friend, and it was you talking about your reasons for leaving the bulge bracket investment bank that I really want to make sure people understand, because that fascinated me.
Well, if early experiences are formative, then my business partners and I, our experience with the use and abuse of models and asset allocation models happened early. So we were 5 of us basically, co-founders, who worked together in a private bank at Bankers Trust Company, which was subsumed by Deutsche Bank not too long after we left. And we had fine old careers there, each doing something slightly different. So something that began to happen there was that the original business of the investment advisory and trust department of Bankers Trust Company, which is the original business of Bankers Trust Company, I think it was established in 1903, that had become a backwater as the rest of the bank grew around it, particularly derivatives trading and institutional investing. And so they still did business the way they always had. And you had your standard portfolio profile. Depending on the client, they're a taxable client. Maybe 40% of an account might be in municipal bonds. If they live in Connecticut, there'll be a weighting toward Connecticut bonds. There'll be your equities, and that's how you do it. Well, there came a point in the early 90s when those who managed the derivatives business of the bank had run out of low-hanging fruit, and they were casting about for greener pastures. And they came in, they must have peeked over the wall, I'm imagining like in northern England, North Yorkshire, these nice stone walls separating fields and farms, and looked at those rolling green pastures of, I think, at the time, $10 or $12 billion of assets under management in the private bank. And they looked at the returns we were getting on that. They said, you know, what's with 50 basis points or 100 basis points? We can do better than that. Now, you can't just go in and say, we want to put derivatives into client portfolios. You have to set it up properly. You have to have a methodology and a motive that's acceptable. And so they introduced us to the developing concepts of the modern portfolio theory and asset allocation models, and the idea of the covariance between different asset classes. So of course you have your bonds and your stocks and cash, but then of course there are international stocks. They might go up when US stocks are going down. You might have emerging market stocks. You might even have currencies. And you can look at the statistics that were developed, and you can test them, and so you can see how portfolios could benefit from that. They could be more efficient and effective. So they started with that. And then they had, let's say, some mutual funds they developed, because there's some large cap European stocks you could buy. That's fine individually, but you might want to do it through a mutual fund, which has a certain fee. It's higher than we charge. Now, when you get into emerging market stocks, or perhaps currencies like I'm kid you not, the Thai baht, okay? You might not want to buy it individually, and of course there are issues of setting up separate accounts and so forth. It's complex. So why not buy a CD, a market-linked CD? It sounds very nice, right? It's like taking some money and just going to the bank and getting a CD for it. Now, what they really were is derivatives cut down to retail-sized pieces and polished up. And the way it might work in a simplistic sense is that they would, because it had a term sheet, kind of like a CD, is that if you put some money in, they'll guarantee you that over, let's say, 5 years, you won't go down more than, let's say, 10% from end to end. Now, there is no income paid on this, and you'll go up, if it goes up a lot, 80% as much.
Right.
Right? Now, if you think about the actual granular decision making I would have to make as a portfolio manager. So I have, I'll call her old Mrs. Smith, who lives on Park Avenue, who has some large positions in stocks that her husband originally bought or inherited decades earlier. So DuPont or IBM or ExxonMobil, or Exxon at the time, that maybe had a per share cost of 25 cents or 30 cents and had 5 or 6% dividend yields. And I would have to sell some of those, pay the gains taxes, which were a lot higher than 20% at the time, forego the income, and take my 80 cents on the dollar, or whatever it is I had left, or 70 cents on the dollar, put it into the CD, forego income on that. And in essence, in the CD, I'm buying insurance I don't need.
Yeah.
Because over rolling 5-year periods, almost anything they would suggest you buy is unlikely to go that low.
Yeah.
And you lose all the upside. And because buried in there is, I don't know how many percentage points of profit baked in derivatives. So we did not wish to do that in our accounts. The problem is when you work for an employer who follows what you're doing, and little by little they begin to ask, I understand, Stephen, why is that, when you come in for the periodic review process and they go through your accounts, just make sure everything's
a good soldier,
good soldier. Stephen, why is it none of your clients seem to like this idea? I mean, I know you've spoken to them, right? Yeah. Eventually, the noose begins to tighten, and we had choice to make. It's not exactly the only reason, but it was, for me, it was a very important reason. What are my choices? I could cave, and ethically, morally, I just couldn't do it.
Yeah.
I do harm to a client. I could fight my employer. I could say, this is not right. Now, I could see that the inflection point for the rest of my life and career would be defined by this image of me walking hand in hand with my lawyer up the steps of 280 Park Avenue to do battle with my employer. Or discretion being the better part of valor. We withdrew and had to decide to take the risk of establishing our own company to invest the way we thought was more appropriate.
But
so the idea, so it's really, I went too long on this. The essential notion here is that incentive systems are really important to understand everywhere. And it's important to know whether your attorney is charging you by the hour or on retainer. Doesn't mean that he or she will do a worse job for you in one way or the other, but it's important to understand. It's important to understand that your failure to make a decision is standing between you and your realtor's Hawaii vacation. Not that she won't try to do the best job for you, but it's important to understand that. And in Wall Street, and in our experience with the bank, is they were seeking to increase their fees beyond what they were, and using it seemed like on the surface, a very reasonable set of arguments, using academic and academic work and statistical evidence to suggest that there are good reasons to diversify.
Yeah, but that goes on all the time. It still goes on today. They're still trying to jack fees up. But it's very rare you read the story about the highly paid executive who just walked on a matter of principle. It's all too rare, in fact.
Well, they put us in untenable, for us ethically, it was an untenable situation. But using the framework of academic know-how or various kinds of theories, not to actually improve a portfolio, but to improve your fee flow. So that was a formative experience for us, and perhaps it's always stayed in our minds. And that has great relevance that people should be aware of to today's environment in a magnitude that I've never seen before. And I'm talking about indexation and how that works and how people are investing or misinvesting.
Well, this is precisely why I wanted the audience to get a chance to listen to that story, because I think it, to me, when I hear your story, that forms the foundation. Yeah. If nothing else, it speaks to your character and the way you look at these things. Yeah. And so to hear someone like you talk about indexation and passive investing as being the biggest bubble ever, that pricks my ears up, because we live in a world, I'm looking for things that aren't in a bubble, and they're hard to find. They're really hard to find. And you can argue the extent to which the bubble's been inflated, but it's hard to find cheap assets. So when you hear in a world like this of someone talking about the biggest bubble ever, and to me, arguably the most dangerous, because people like Mrs. Smith in Park Avenue are being herded into these things by everybody.
At the Grants Conference, I started deliberately with something that sounded somewhat provocative, deliberately, because I had 40 minutes to try to provide enough information in a proper sequence so people understand that the way they think they're investing, the way they're exposed, is nothing like they think they are. But it was a long discussion, and it just sounds like a lot of unconnected facts at first until you connect them together. So I wanted to get their attention, and so I used the B word, right? And I said, I think, and I hold to it, I think we were in the biggest bubble ever experienced. And it gets people to raise their eyebrows because they don't think so. They're told there's no reason to think so. And there are all sorts of reasons for suggesting otherwise, and they've heard it. For instance, interest rates are very low, and whether you go through technical exercises like dividend discount models or present value analysis, or just look at history, and when interest rates are low, PEs can be higher. Or there are other simple, obvious ways that makes a lot of sense. If you can only get, because we're in a yield crisis, can't earn enough from fixed income. So if you only get 2.5% in a treasury, 10-year treasury note, and a blue chip common stock is offering you 3.5%, is that not cheaper?
Sure. And
it is. So when I say we're in a huge bubble, and 21 times is not, 20 times earnings, or 22 or 3, is not outrageous, particularly under these circumstances. So at least I have their attention because they want to know, like, how do I justify this? That's how I started. So there are different ways to start, but first I have to get someone's attention. Then I have to take them through the process. That's the challenge.
Well, look, you have everyone's attention. That's sure. Everyone's sitting watching this is now thinking, okay, you got me. Now walk me through it.
I'm going to start a little differently than I did in the Grants Conference. I want to show that whatever you think you know you're buying is not only not necessarily so, it could be so different than you think it is, that it might even shock you. That a fact is not a fact. That I'm going to show you a magic trick, in fact. And I'll choose something that people think is, and understandably so, I have lots of tangential, interesting, marginal funds to talk about that are interesting, but people don't necessarily think that they're relevant to them. So I'll pick something very relevant, something accepted, and I'll show you it's not what you think it is. I call it semantic investing, is going on now with ETFs and indexation. And I'll explain it more later, but I think I have to start with this, and I'm going to refresh my memory. So we'll start with the NASDAQ 100, okay? QQQ is the ticker for one way to get a hold of this. And it's got $50 billion in assets, so we know what this is. Now, active management versus passive. So in active management, if people don't want active management, the idea is that your returns are in large measure determined by individual security selection. The idea in passive management is you're more diversified as to security-specific risk, and security selection should not be impacting your returns. You want to buy the entire market, you want exposure to the market, that's what you get S&P 500. You want exposure to a sector, even. REITs. At least you get exposure to the entire sector, and it's not going to be dominated by whether one particular company does well or not. That's what you're buying in part. Okay, so for people who don't know, when they buy QQQ, the NASDAQ 100, they probably don't know that 41% of the whole weight of all the money in the QQQ is in 1, 2, 3, 4, 5 stocks. Okay, that's Apple, Google, Microsoft, Amazon, and Facebook. That's number one. So number one, you've got 41% exposure. Now, as an active manager, I would be sanctioned if I had 40% exposure to one sector. And in fact, in certain jurisdictions, like the European Community, there are UCITS funds, like mutual funds, which prohibit a fund from having more than 40% in any series of stocks with 5% or greater weighting. And the UCITS version of QQQ, which trades and has over $1 billion in it, actually has over 41%. So apparently it's okay for an index to violate certain norms that it's not okay for an individual manager to do, or an active manager. Okay. Now, here's a magic trick. So the PE of QQQ, or the NASDAQ 100, is said to be 22 times trailing earnings, okay? Which is more or less what the S&P 500 is. They say, well, that's pretty good because it's also higher growth, it has some technology, and it has these stocks in it, and that's not very expensive. Okay. Now, PE. Now, when you say, if you were to say to me, I've got these 100 stocks and the average PE is 22, I would naturally, and I shouldn't be faulted for thinking that you take the PE of each one and you divide it by 100.
Right.
Or maybe you weight them by the largest one times its PE and the second largest one by its weight, and you add those up and divide. But you get an average, that's an average weighted PE. It's not exactly done that way. So here are the couple of tricks that are used. The magic trick, by the way, is I'm going to show you how to turn a PE of roughly 56, give or take, into 22. Okay?
Well, some would say half the stock price, but
Yes.
that's one way of doing it.
That's one way to do it. But here's how to do it without having the stock price. Here's how to scramble eggs without breaking the shell. Okay? So, number one, the methodology is that if some company in that index has a negative earnings, which means a negative PE, they don't include it.
Okay, they're all out. All the bad companies are out.
Okay? If some stock has a PE that's extraordinarily high, meaning more than 99 or 100, it's excluded. So drop that out.
There goes Amazon, okay.
Because it's an outlier. So Amazon.com has, I believe, a trailing PE recently of roughly 180 or 90. So that drops out.
Okay.
So that's a help. Now, by the way, Amazon being a 7% position in the Russell, in the NASDAQ 100, if it were included in the PE, it would raise the index PE by 12.7 points.
Right.
Okay. So really, even starting from the 22, you'd be to 34 or 35. Okay. So, but we're not done yet. Okay. There's more to it. It's very creative. It's very interesting. I find it fascinating. Before we get to the third trick, by the way, if someone looked at the sectoral diversification of the the NASDAQ 100, you see information technology is 57% weighting, and then consumer discretionary is 22%. That's pretty concentrated.
Yeah.
But even so, people say it's okay. I'm willing to take that sectoral diversification. Now, Amazon, it happens, is not included in the information technology sector. It's included in the consumer discretionary sector.
Okay.
Now, someone will say, well, I see where you're going, Steve, but that's arguable, and I think that really the business is being pushed by the consumer sector, and I'm okay with that. And I'll say, well, let's look at a little more information first before you make the decision. So, Amazon has something called Amazon Cloud Services. And that has servers. It's for the cloud.
Yeah.
People use that. It is the largest in the country. It far outstrips those of Oracle or IBM or any of the other competitors. Also, it's growing faster than the rest of the business. Still, it's all arguable. Except, we did this before, so I asked you a rhetorical question because you know the answer. And you guessed correctly anyway, or maybe you knew, is that the Amazon Cloud Services division, I asked you, do you know what proportion of Amazon's earnings in 2016 it accounted for? And you told me?
I guessed 100%. But
more than 100%.
yeah.
The Amazon's domestic consumer business that we generally think of had a profit. They also have an international division, which had a bit of a loss. And Amazon Cloud Services eclipsed them both. So I think it belongs in information technology. And if you did that, well, then information technology wouldn't be 57%, it would be 64%.
Right.
Okay? But the final bit here is how you change a PE. When is a PE not a PE? So they tell you the PE is 22 times trailing. They do something else then. After they've dropped out the losers in terms of negative PE, and after they've dropped out the ones above 100, then they give you what they call harmonic PE. A weighted harmonic average. Now, if you see the tear sheet, the information sheet for these, it'll give a little asterisk there, and you can follow the asterisk down to the bottom where they talk about it. And here's what they do. I'm going to say something, then I'll explain it. When you create a weighted harmonic mean, what you do is, it's also referred to as a sub-contrary mean. It uses the reciprocal of the arithmetic mean of the reciprocals of the set of weighted PE multiples. Okay? So let me walk you through an example. And even though I'm speaking numbers, I think it'll be easy enough to follow. If I just make up 4 stocks, one has a PE of 50, 110, 120, and 130. Okay? So I take step 1, I turn the PE into its reciprocal, meaning 1 over 50. So that is 0.02, or 2%. And the one that has a PE of 10, the reciprocal of that, 1 over 10, is 0.1.
Yep.
And I do that, and I add them up, okay? And I average it. So the PE of equally weighted of 50 and 10 and 20 and 30 is an average PE, the way people think of it, as 27.5. And when you went through the exercise and turned them each into their reciprocal or percentage, and you average those, it's 0.05, 0.0508, meaning 5%.
Yeah.
And then you take the reciprocal of that. You turn it upside down, you turn it upside down again, and all of a sudden, the PE is 19.7.
Right. Now, do they tell you why they do this?
I guess it's better. So we went through the exercise, and we took the largest companies, Apple, Google, Microsoft, Amazon, and Facebook, the top 5 positions in the NASDAQ 100 index, and we just used them alone. And we looked at their simple average PE, which was 55.7, and their weighted average, which is 50.3, and their harmonic average, which is 30.8,
right,
and their weighted harmonic average, which is 28.1.
Right. It's like walking downstairs. It's
so
remarkable.
I start off our conversation with this to demonstrate that people do not know what they're buying. And they're buying a lot worse than this.
Well, it's worse than that. It's not that they don't know, it's that they think it's something altogether different.
But there are other examples. It's semantic misinvesting. Now things are labeled in an index and ETF, and people go by the label. Why shouldn't they? But what they're getting is entirely different, sometimes diametrically different than what they think they're getting. And I don't think that's fair. And my speech at Grants was a kind of a stroll through the garden of time to show how we got here, so people understand the mechanisms by which it happens. So you have to, I think, have an understanding of that so you can sidestep risks that you don't realize you're taking.
But some of those things you laid out in the Grants conference, which is why this was just such a bang moment for me, it was stuff that I kind of instinctively knew. I knew about Exxon, this 44 PE, which is so out of whack because it's, I forget the number you gave, how many ETFs it exists in now, which is crazy. And the ones that really just confound me are the junk bond ETFs.
Good place to start, because that's why I started.
Yeah, it's outrageous.
By the way, first of all, not everybody has the time, much less the inclination or the ability, to sit down and figure all this out. Just we've been watching it for a long time. There's a concept called learned helplessness. I think we're all familiar with that. But
Teach me.
The laboratory version is if you have a bird in a cage with a or a bird on a stick with a chain on its leg. It learns that it can't fly. And one day you can open the door of the cage, or more likely maybe take the chain off, and it won't fly either.
Right.
Learned helplessness.
Yeah.
And we get that way when we're overwhelmed. I do not watch or listen to financial news networks. I don't even read the Wall Street Journal anymore. The only financial news network I listen to is for about 10 minutes a day is when I'm shaving. I have a Bloomberg radio. It's a little box with only one station. All you can do is turn it on and turn the volume up, which I was handed on the street one day when Bloomberg years ago had people on the street trying to advertise Bloomberg radio, because you had to start it at some point.
Yeah.
And so I get to hear for 10 minutes what they're talking about. And even limiting myself to that, what you're faced with, and I imagine clients of mine at home or anybody, they hear 1,000 opinions all day long. Every shade. What to do? How can you integrate this? How can you assess it? You can't.
Yeah.
Learned helplessness. You just give up, and you do what your broker tells you. You do what your sister-in-law or brother-in-law whispers in your ear. How else can you operate? Or you're given the option of these nice ETFs, and I'll talk to you about those. So to start on this, I called it the valuation sobriety test. And the reason I started with the example of an emerging markets bond, ETF, okay? And the reason I started with that is when you talk about stocks, it doesn't matter whether it's Amazon or Tesla or anything else, you can argue till you're blue in the face. And I can legitimately, for myself, I can argue both sides of it.
Yeah.
Right? Because there are too many variables. Amazon, how long will the growth rate last? What will be the final profit margin? With a stroke of his pen, Jeff Bezos can make the profit margin 3% tomorrow if he likes, right? What's the terminal PE? Should PE be 20 or 30 or 5? Should it be in 10 years or 20 years? And all these factors are arguable. It's much easier to make an argument about valuation with bonds because there's just not so much room. There are fewer variables to discuss. There's going to be a maturity date. You're either going to get your principal or not. You're going to get your coupon in the interim or not. And it's not such a difficult science to determine whether a bond is more or less money good or has some serious risk. Okay? So I'll start off with this valuation sobriety test. You've seen it, unfortunately, so when I ask you the question, it's not really as
I'll be a stooge.
dynamic.
If you need me to be a stooge, I'll be a stooge. But there'll be plenty of people watching that you can ask the rhetorical question to them.
So these are some major holdings in the iShares Emerging Markets High Yield Bond ETF.
And the very fact that such a thing exists,
Such a thing
it
exists.
kind of boggles the mind.
Well, because they tell us that when you put it into the mix and it's part of your it's part of your asset allocation model, it reduces your volatility a little bit because they act differently, and it increases your yield a little bit, and that's good, and therefore you're better off.
Right.
So first we need a framework. We need a benchmark. So U.S. Treasury notes, 10-year Treasury notes, are right now about 2.3%, maybe a little lower, depends on the week. I'm reading from some figures I took some weeks ago. An IBM AA minus 10-year bond. Now for the touch more risk, it's a corporate bond, it's not a treasury, it's priced at 3.3%. It's an extra 100 basis points, an extra 1 percentage point. And I think most people would agree that seems fair enough for the extra risk. And then we could take a CCC plus bond, but by a known business that's an improving credit, Wendy's. They have a 9-year note, and that's 6.3%. That's another 3 percentage points. Okay. People say, okay, for the extra credit risk.
A little light maybe, but
I'm willing to do it.
Yeah.
And just to compare it with a benchmark, we have the iShares High Yield Corporate Bond ETF, and that's 5%. So it's lower than the single risk credit of Wendy's 6.3. It's higher than IBM. Makes sense. Okay. It's 2+ times the 10-year Treasury note. Okay. Now, the sobriety test is I'll ask about 3 major holdings in this ETF. There are Russian Federation, BB+, they're rated, 13-year bonds. Okay. So I don't need to say too much about what people have their own opinions about the Russian Federation and its credit risk. We'll say that in 2016, I believe they fired 1 in 10 government employees and civil servants, which is the literal meaning of decimation,
Yes.
to save money, to balance their budget, which they can't do because oil prices went down tremendously, and oil accounts for probably half of their cash inflows. Then there is Petrobras, as a 4-year note. You can count up the number of former officers and senior executives and directors
Scandal, yep.
in jail.
Yeah.
There's the Lebanese Republic, Lebanese Republic, B-, 4-year note. Okay, Lebanon, just for some more background before one makes a decision. It's about the size of New Jersey, in the lousiest Middle East neighborhood.
That's right.
Right, bounded by Syria. You have Hezbollah in the south, acting as a state within a state, participating in the Syrian civil war. Civil war in Lebanon could break out at any moment. GDP numbers have not been published for years. They can't get it together. The most recent GDP numbers I saw, I think, were from 2008. And I looked on the website of the U.S. Embassy, the Lebanese Embassy in the United States.
Yeah.
And I looked at the format. It looked familiar to me. Then I went to the CIA fact book. I think they just came directly from the CIA fact book. So anyway, they have bonds, and they're all in this fund. And so, and by the way, as a benchmark, so you can think about it, the iShares Emerging Markets High Yield Bond ETF, the entire ETF, has a 5.3%
Okay.
yield to maturity. So it's a touch higher than the iShares domestic high yield corporate at 5. So what yield on 13-year Russian bonds? You know the answer. What is it?
I get them all mixed up. I remember the numbers and sit there.
It's 2.3%.
There you go,
It's
yeah.
the same as the U.S. Treasury note.
Yeah.
Petrobras, 4.5%, a touch more than IBM's,
Yeah.
less than Wendy's. Lebanese Republic bonds, 5.1%, better than Wendy's. Wendy's, if they were to reincorporate in Lebanon, could save themselves 1.2 percentage points on 6% yield.
A year.
That's big.
Yeah.
Okay. So the reason I use this example is because all of us can understand that those are not real prices.
Right.
Use the mental experiment that you own units of this fund. Now, when money comes into the fund, how does this work? Let's not forget that the market is about supply and demand. It's a marketplace. Period.
Yeah.
When money comes into this fund, number one, by regulation, they have to invest that promptly. And they, in a sense, they do it very accurately in the precise weightings each set of bonds deserves. Now, what if there's not a lot of supply of the Lebanon bond? The money's coming
It's
in.
not a huge stretch for the imagination.
So they buy it. They buy it at that price. That's the going-in price. Do we really think, and we know what the answer is, do we really think that if we own units or shares of this ETF, and for some reason the ETF decided to disband and pay us in kind, they're just distributing to us our bonds in kind, do we really think we could sell the Lebanon bond at a 5.1% yield? Or the Russia bond at 2.3% to somebody? No, we can't. We know that.
Yeah.
That's just an object example of how supply of bonds versus demand for bonds, the demand meaning money flowing into this fund, buying what really isn't available, and therefore bidding up the price to somebody who's willing to sell it to you a higher price. Yeah. That's how it works. That's supply and demand imbalance. And you take this, and you can take this lesson and apply it to the rest of the stock market now that's in what I'll call the ETF vortex. And then we can start on a history of how we got there.